Well, good morning. It's Monday, December 16th, and we got a brand new week. Christmas is right around the corner. But before I get into the trading action, let me talk to you about what's on the table this week and all the good stuff that we need to focus on. The beginning of the week, not so much. The Red Book I would focus on. That's a private report, very important in terms of retail sales and in terms of how the overall economy is looking. That's something you may want to focus on. But again, that's a private report. Nothing really juicy happens till Thursday, which means, well, we have Charles Evans speaking, but honestly, based on what the Fed is saying, and they're being very consistent, they're not going to do anything for a while. There's no need to do anything for a while. China, it's getting resolved. If it wasn't, maybe then they would lower rates again. But we're in phase one, so things are looking better. Now, Thursday we have jobless claims. The numbers have been outside of the range, but by a very, very little, not by a huge amount at all. Existing home sales, but bottom line is jobless claims. The average has been going up just a bit. The consensus is about 221,000, right around the 4-week average. Anything around 210, 220 will be okay. Prior was 252. It hasn't been revised yet, but it's spiking up. But with that said, all the other indicators, the retail numbers, the wholesale trade numbers, the jobless, the employment situation numbers were just off the charts. Bottom line is, economy is humming along. I wouldn't focus too much on this 252 number, especially if the number this coming Thursday is within this range. So I really wouldn't make too much of it. Let's continue. The big report this week, the real big report this week is going to be the GDP, the quarterly GDP. We're going to know, and consumer sentiment. But consumer sentiment, I believe, is going to be positive. The big one, this is the quarterly GDP. This is the quarterly economic report. This tells us if economy is humming along or not. So far, it's been on target. Let me show you what the consensus and the range is. Again, I don't know if you guys, how long you guys have been following me or the economy, but the target for the last few years has been 2%. Ever since Obama's been in the office, it's been about 2%. And you know what? It's been on target. We've had it heat up a few times. But as long as we're right in the range of about 2%, 2.1%, things are going well. The Fed has absolutely no reason to lower rates. And here's the problem with lowering rates. Bonds, let me show you this. You guys got to see this. This is really important. Remember, this is what I'm drawing right here. It's not interest rate. It's the bond market. Pay attention. The bond market is inverse from interest rates. So when interest rates go up, bonds go down. When bonds go down, interest rates go up. It's real simple. They have an inverse relationship, okay? Inverse. Not uncorrelated, which means they just kind of don't follow each other. They do follow each other in an inverse fashion. When interest rates go down, bonds go up. When bonds go up, interest rates go down. So the Fed started really aggressively lowering, I'm going to say it again, lowering interest rates right here. Lowering interest rates means bonds rally, and they did. And then the Fed lowered interest rates again. And what did the bonds do? That's my cat talking. Let me let him out. So around here, the Fed lowered rates again. But guess what happened? The bond market went south. And then they lowered rates again. And you know what happened? The bond markets went south. Now, you're probably thinking to yourself, Roger, they're lowering rates. This is inverse. Bonds should be going up. Yeah. And you know what? Remember how they're saying that they may lower rates again? Bonds have been going. Bonds have not been, I'm spelling it out for you here. Bonds have not been reacting. The long bond, this is the 20-year plus bond. This is the one everyone focuses on trading. We don't look at the 30-year note. This has been going south, which means interest rates are not going lower. Even though Fed is lowering the short-term rate, the long-term rate, the housing rate, the 30-year, the 20, the 15, the 10-year rate, anything beyond 10-year, they follow each other almost. If I was to show you the 10-year, the 20-year, the 30-year bond futures, their correlation's like 98%. So we just call it the long bond. Okay, just to make it easy for you. And this is an ETF, exchange traded fund, that you could trade with any stockbroker that follows the long-term bond. So bonds are going lower. Interest rates are not really going lower. They're actually going a little higher right now. If you look at the 30-year bond, the one that you get financed when you buy a house, the one you have to pay back the government, usually it's government, Fannie Mae, Freddie Mac. Anyway, the bottom line is they're not responding. So the Fed's not taking any action and the bonds aren't responding. So the bonds are not going to save the day. And the bonds are not reacting to the Fed very much right now. So unless the Fed says something that's really out of whack, bonds are not going to save the day. And that's okay. That's okay as long as China and US keep their word and will work out in the economy. So let's look at some pleasantries. I told you about a week and a half ago we're going to have a congestion and we're going to break out. I had no idea which we were going to break out. I did say that if China and US resolve the trade war, we're going to break out to the upside. If they don't, we're going to break down to the downside. Now, the market is getting overbought around here. That doesn't mean we're going to go south. That means we're more than likely, as I said on Friday, we're going to congest around here and then make more highs as long as Trump and China don't take this deal off the table, as long as there's no major disagreements. But phase one, we have a phase one. That's really, really important. And this is what it means. It means that smaller stocks are going to start leading, and they're still leading. It's still hard to say, but so far, for the last 2.5, 3 weeks, small caps, look at this. This is an ascending congestion pattern, and this is a descending congestion. See this high right here? It's lower than this high. But if you look at the Russell, this high here is higher than this high. Folks, that's the first time it's happened since late August, early September of last year, of 2018, not 2019. And that means the small caps, which are much, much, much more impacted by China and U.S. economy, are starting to make a comeback. And that is so good for the stock market. All right. This is positive. This is really, really positive. I'm really happy about this because this trade war has been bugging the hell out of me. Excuse my language. We've been in no man's land and the small caps have been preventing the large caps from really making big moves. And now the small caps are not just participating. Look at this. Look at how much more they have to go just to make up with the large caps, just to fall in line with the large caps. And they're going to do it. I'm telling you, they're going to do it. They've got to come up here. We've got to move from 164 to 172 just so that the small caps will be in line with the large caps. And again, for the first time, pay attention. You know why? For example, a smart, savvy trader may want to put on a spread. What kind of a spread, you may ask? Well, how about buying equal amount of shares, and not equal, but volatility-based shares on the Russell, on IWM. You could do it in a stockbroker account and selling, for example, I'm not telling you what to do, I'm just theorizing, and selling SPY because the Russell should outperform. Now, you can't buy equal amount of shares because they have different volatility. So you would use volatility measurements to measure the trading range and figure out how many shares to buy to get equal exposure. Sorry, I'm hitting the mic. Get it? And if you guys are a little confused about what I'm talking about, you should watch some of my videos where I talk about how to equalize exposure using volatilities, which is exactly how multi-billion-dollar funds trade. And by the way, speaking of multi-billion-dollar funds, I'm really excited about this trade war. Things are going to heat up in 2020. The small caps are going to come back. This is going to be the best time ever. And this is why I'm revealing my 2020 blueprint today at 1 p.m. Eastern time. You don't want to miss it. I'm going to tell you everything I expect to happen in 2020, the odds of it happening, how it's going to happen. Folks, I plan on doubling my entire trading account in the next 12 months, and I'm taking you with me for the ride all the way, every way. We're going to have, this is going to be the coolest thing. It starts at 1 p.m. I'm going to tell you all about it. If you want all the details, and if you want to learn of my step-by-step, I mean, this is a step-by-step formula to doubling your money in 2020. It's my 2020 wealth blueprint. You don't want to miss out. Check this training. It's going to be very, very cool. We're going to have some videos. We're going to have giveaways. It's going to be really fun. It happens at 1 p.m. today. Click the button below. Find out all the details. Don't miss out. Folks, with the small caps making a comeback right now compared to the large caps, and with interest rates being near all-time lows, and stock markets being at all-time highs, it's time to get into my 2020 Wealth Blueprint. It really is time to get in on a blueprint. Don't miss out, 1 p.m. Eastern Time. You'll get all the details of how I'm going to double my account in the next 12 months. You don't want to miss it. Talk soon. Take care. See you at 1 p.m. Don't miss out on this. It's going to be one of the most important events of this year. I'm not kidding you, especially with the small caps doing this. I'm too excited. I got to go. I'll see you at 1 p.m.